Tariffs are intended to protect industries, but like it or not, they often end up hurting everyday Americans. So, who is really being protected? Warren Buffett warns that while tariffs might start as a policy aimed at businesses, they quickly turn into a problem for households. Higher costs for materials force companies to pass expenses down to consumers, whether it's in the price of food, phones, or even the clothes on your back. So, what happens when the business struggle to adapt and families are left to pick up the tab? In this video, I will show you the domino effect of tariffs, how a business problem becomes a people problem, and what Warren Buffett's warnings mean for your future. And is there a silver lining to all of this? But first, let's set the stage. This chart shows the trends in the U.S. tariff values from 2017 to last year, showing significant economic and policy shifts. Section 232 tariffs on steel and aluminum, introduced to protect national security, peaked early in 2018 but steadily declined, with steel tariffs dropping from $15.9 billion in 2017 to just $5.5 billion last year. Section 301 tariffs, implemented by the U.S.-China trade war, dominates the chart, especially List 3, which fell from $159.2 billion in 2017 to $86.5 billion in 2023, showing businesses diversifying away from Chinese imports. Derivative tariffs, introduced in 2020, remained smaller contributors, while the Biden administration's 301 expansion steadily rose, reaching $18 billion in 2023. This chart shows how tariffs reshape supply chains and trade practices, with Section 232 protecting domestic industries and Section 301 targeting unfair trade practices, like intellectual property theft and trade imbalances. The ripple effects continue to influence global economies. Tariffs disrupt global markets by increasing costs, disrupting supply chains, and reducing trade volumes. Acting as taxes on imports, they inflate prices for consumers and businesses alike, leading to higher production costs and reduced profitability. Retaliatory tariffs escalate trade wars, destabilizing international relationships and causing market volatility. Developing nations reliant on exports face significant economic slowdowns, while businesses relocate to avoid tariffs, reshaping trade patterns. Ultimately, tariffs create inefficiencies, they hurt consumers, and they destabilize the global economy. Warren Buffett has consistently warned that tariffs act as a tax on consumers, disrupting free trade and leading to higher prices and economic inefficiencies. In light of President-elect Donald Trump's recent tariff announcements, 25% on imports from Mexico and Canada, and 10% on Chinese goods, Buffett's concerns are more pertinent than ever. Reflecting on the 2018 trade war, Buffett noted that such measures could have far-reaching global consequences, including inflationary pressures that negatively impact consumers. During that period, U.S. businesses paid an additional $77 billion in import taxes, and American households faced an average annual cost increase of $1,277. Retaliatory tariffs from China targeted $110 billion worth of U.S. goods, leading to a 50% drop in soybean exports. In the current climate, consumers are already reacting to the anticipated tariffs. In fact, most Americans believe that it's a good time for major purchases, fearing upcoming price increases. This preemptive buying behavior can lead to inflation even before tariffs are officially implemented. Buffett has always advocated for clear communication from leadership regarding economic policies. He believes that understanding the tangible impacts of such policies is crucial, especially when they cause immediate economic hardship. This is the delicate, balanced trade policy that is required to avoid destabilizing economies and harming consumers. Now, imagine this. Your daily grocery suddenly costs 30% more. And that's not because of inflation, supply shortages, or surge in demand. It's tariffs. Now multiply that pain across industries. Cars, phones, building materials, even the clothes you're wearing. This is the domino effect President-elect Trump's renewed tariffs threats are poised to trigger, and the fallout is already making headlines. Let's start with consumers. Tariffs might sound like a problem for businesses and manufacturers, but in reality, they hit ordinary households the hardest. A proposed 25% tariff on imports from Mexico and Canada, for instance, is likely to jack up the cost of fresh produce. Avocados, a staple in many kitchens, could jump by as much as 40%. The same applies to tomatoes and other vegetables, items that are essential, not optional. On another front, the 10% tariff on Chinese imports is expected to make electronics, like phones, laptops, tablets, these things we rely on, about 15% more expensive. For the average family that's already stretching its budget, these price hikes could be devastating. But it doesn't end with grocery bills and gadgets. Behind the scenes, the very fabric of modern trade is being stretched thin. Supply chains, which link countries in a seamless exchange of parts, goods, and raw materials, are now under threat. Think about the car industry, for example. Many vehicles assembled in the US depend on parts imported from Canada and Mexico. A 25% tariff on those parts could send costs soaring, forcing automakers to either absorb the hit, that's unlikely, or pass it on to consumers, making new cars even more expensive. Retailers, too, are bracing for impact. Clothing brands that rely on factories in Mexico are already calculating how much a 20% increase in production costs will affect their bottom line. Meanwhile, logistics firms warn that stricter trade policies could create bottlenecks at border crossings, delaying shipments and driving up transportation costs. And then there's the stock market, where uncertainty breeds chaos. It's only early 2025, and yet we're already seeing tremors. History tells us what happens next. Sectors that depend heavily on international trade, such as tech and manufacturing, are the first to feel the pressure. Stocks tied to these industries often lead the decline, spooking broader markets. Analysts are already forecasting that if these tariffs take hold, the U.S. GDP could contract by 0.4%, a significant blow to the economy trying to regain stability after years of pandemic-related disruptions. Meanwhile, global trade partners aren't sitting idle. Retaliation is a certainty. Countries like China, Mexico, and Canada have already hinted at countermeasures. China, for instance, could target U.S. energy exports, a critical component of the domestic economy. Mexico has signaled that its willingness to impose duties on agricultural imports, this move would hit American farmers hard. The geopolitical chessboard is being reset, and no one, not consumers, not businesses, not investors, are immune to the ripple effects. At the same time, another silent force is at play: inflation. Economists are already warning that these new tariffs could add 0.7% to the inflation rate, pushing already cautious consumers further into defensive spending. People are likely to cut back, but not just on luxuries, on essentials as well. This kind of widespread hesitancy can create a self-fulfilling prophecy. As people spend less, businesses pull back on investments, creating a vicious cycle that drags down economic growth. So, how should you navigate the uncertainty created by Trump's tariff proposals? First, let's address the elephant in the room: panic. When tariffs hit and the markets start to dip, the first instinct for many investors is to sell everything and wait for the storm to pass. Buffett argues that this is the worst thing you can do. Historically, markets recover from shocks, and selling in a downturn often locks in losses that could have been avoided. For example, during the first tariff war, some investors who pulled out missed the recovery that followed when markets adjusted. Buffett's advice is clear: stay invested and avoid knee-jerk reactions. He said, "Be fearful when others are greedy, and greedy when others are fearful." Next, focus on sectors that are resilient in the face of trade disruptions. Industries like utilities, healthcare, and domestic consumer staples tend to weather tariff-related storms better than those reliant on global supply chains. For example, a healthcare ETF or a stock like Procter & Gamble, companies that produce essential goods domestically, may be less affected by import taxes. On the other hand, sectors like technology, automotive, and manufacturing could face significant headwinds as tariffs inflate production costs and disrupt supply chains. Diversifying your portfolio to include more of these resilient sectors could be a smart move. Buffett has also emphasized the importance of long-term thinking. He's famous for saying, "The stock market is designed to transfer money from the impatient to the patient." This means avoiding the temptation to time the market, especially during periods of volatility. Instead, consider a strategy like dollar cost averaging, where you invest a fixed amount of money at regular intervals regardless of market conditions. This approach reduces the impact of short-term fluctuations and ensures that you're steadily building your portfolio. Another key principle in Buffett's playbook is holding cash. While Buffett is known for his love of stocks, he also keeps significant cash reserves to take advantage of opportunities during market downturns. Tariffs create uncertainty, and uncertainty often leads to undervalued stocks. By keeping some cash on hand, you'll be ready to invest when prices drop, aligning with Buffett's approach of buying great companies at a discount. Tariffs are rarely isolated in their impact. They trigger a ripple effect across industries, countries, and even innovation itself. Trump's latest tariff proposals threaten to reshape the global economy in ways far beyond their immediate scope. From supply chain disruptions to unintended beneficiaries, the fallout could leave a lasting mark. The first ripple begins with global supply chains. Industries far removed from the initial tariffs, such as retail or technology, often bear the brunt of cascading disruptions. For instance, many manufacturers have already turned to Vietnam to sidestep the US-China tariffs. But this has created new bottlenecks as factories in Vietnam struggle to meet global demand. As a result, prices rise and production slows, affecting consumers and businesses alike. The second ripple strikes at innovation. In industries like semiconductors and electric vehicles, where staying ahead of the curve requires massive R&D spending, economic uncertainty from tariffs is a major roadblock. Companies hesitate to invest when profit margins are squeezed by rising costs, creating a slowdown in technological advancements. Finally, there's the unexpected dynamic of winners and losers. While tariffs hurt many, some regions or industries stand to benefit. Domestic manufacturers, for instance, could gain a temporary edge as consumers shift to locally produced goods. However, these benefits are often short-lived as rising input costs catch up. Meanwhile, non-tariffed nations, such as India and Vietnam, may emerge as long-term winners by attracting companies looking to escape U.S. tariff zones. Just like Buffett said, look for value in the chaos. Companies with strong fundamentals and limited exposure to international trade could be excellent buys if their stock prices dip due to market volatility. Tariffs are not the only problem the U.S. faces. There's also the $36 trillion national debt that keeps rising by the second. Trump believes he can fix it, but can he? Click the video on the screen to find out.